Hi there, and welcome to the 12th episode of the Money Side Up podcast. It's hard to believe, Joel, that we're already at number 12. 12 months in, 12 episodes. Fantastic.
Yeah. And just how fast this year has gone so far already.
Oh. Absolutely. Now, look, if you're joining us here for the first time, welcome and thank you. The Money Side Up podcast was set up and designed to really unpack, demystify, declutter, simplify all areas of personal finance for Australians at home and all over the world. I'm based in Singapore. My well-dressed friend Joel is down in sunny Perth, although, as I understand it, not so sunny today. And obviously, we've got plenty to unpack. My name's Jarrad Brown, Senior Financial Planner here. And Joel, why don't you introduce yourself?
Yeah, so I'm a Senior Financial Planner here with Ally Wealth Management. We obviously focus on my Australian expats living all over the world. And so we look to really reconnect and look at ways to simplify and make any Australian expat journey as easy as possible when it comes to the sort of money matters. Before we obviously dive into the podcast for today, we do have a little disclaimer, obviously, to keep our legal team happy. Everything that we discuss here, we'd like to sort of remind you that it is general in nature, and both Jarrad and myself are licensed financial advisors. So if you would like personal financial advice, please get in touch with us directly and we will be happy to go through that process with you.
Fantastic. Well, Joel, let's dive straight into the content today. It's been, I think, to say the least, pretty eventful of late. We're recording this early December. I do feel like everyone has just realized that Christmas is just around the corner, but we're not here today to talk about Christmas or necessarily sales or anything of that nature. There is plenty going on in the world of personal finance. So why don't we start with one that probably impacts a number of our clients, both in Australia and all over the world, and that is this HECS or HELP debt repayment forgiveness program. Bit of a vote grab, you might say, but good news nonetheless. So what have we got? About $3 billion wiped out for 3 million Australians. I think everyone kind of discovered what indexation actually meant when that one hit last year. But maybe do you want to walk us through some of the numbers and what has actually happened, what's been announced there, and what it means?
Yeah, of course. So look, you're probably right to an extent where, is it a bit of a Labor vote win? But they've sort of vouched that if they win the next election, they're proposing that up to 20% of student help or HECS debts are going to be removed. So that is basically a package worth about 16 billion Australian dollars, which, the latest figures which came out on this is the average HECS debt is around $27,600. So obviously 20% of that is $5,500. And so that could be coming off, that sort of repayment schedule. And this is all sort of stemming back to this cost of living crisis. How is the government going about helping and to, ease that burden? As we know, or if you don't know, if you're an expat currently, you still need to declare your worldwide income in Australia for the calculation of that HECS debt repayment. So this is just, I suppose, another way to sort of ease up that cash flow burden that sort of this recent inflationary times have taken on the households.
Mm-hmm. Definitely a big one. And I think probably a really good point you make there, Joel, around this whole Australian expats needing to actually declare their worldwide income. Mm-hmm. It's really important to note there that doesn't mean file your tax return. So if you're already filing your return or you're not filing your return, it doesn't mean you're doing anything right or wrong if you're still not declaring your worldwide income and making those minimum HECS repayments. So you do need to convert to Aussie dollars. You do need to declare it. You do need to make those repayments. No matter where you live. I guess a few other sort of logistics points. I understand the 7.1% indexation from 2023 will go down to 3.2. So it's going to be the lower of CPI or WPI, which is basically general inflation or wage inflation. So some good news for Aussies all over. And the 4.7% this year will be down to 4%. So I guess good news on all fronts. If you paid off your HECS prior to that indexation last year, well, tough luck. good for you for being financially responsible. But the Labor Party is not after your vote. I'm joking, of course. You were not impacted by that significant indexation or significant increase in student debt. So unfortunately, nothing on the cards for you, but it does mean at least you don't need to be declaring your worldwide income and you don't need to actually be making those repayments. But look, I think good news on all fronts. I personally believe university costs, not just in Australia, but globally, particularly for some professions, depending on income expectations, have become a bit ridiculous. But gosh, we probably will leave that rabbit hole alone and dive on to our next topic. Let's talk about interest rates. What's the RBA going to do? Give us some good news, Joel.
Well, I suppose it really let's just start pulling apart which major newspaper you're reading as to what they're saying more or less. But at the moment, the RBA has basically ruled out that there's going to be any rate cut for 2024. So I suppose time will tell what that will look like in sort of the first quarter of 2025. The rumors, the rumblings there are sort of February, March. We might start to see 25 bips come off from that cash rate, which is currently, as of today, sitting at 4.35%. So it's, still quite high. And, we're already starting to see that other sort of developed economies around the world are starting to cut rates. So inflation in Australia is still being quite stickily high, and the RBA is really just looking at that, and they're just, I suppose, wanting to see that slow down. And Christmas, just in general, is generally an inflationary period. Obviously, we have a lot more spending. We have a lot more consumer discretionary goods being purchased. So these are the things that I would say are seasonally expected, but they do impact those sort of inflation figures.
I think we're starting to see some of the news around, what will happen to property prices, what will happen to growth assets when interest rates do get cut. I think there was an interesting headline in, I think it might have been the Sydney Morning Herald, but, I'm sure we see a lot of these in most papers where, property prices in the East Coast are tumbling and, we're not going to see a rally as interest rates start to come off, and property prices are down 30, 50, 80 basis points. And yes, that's 0.3, 0.5 and 0.8%. I mean, the reality is a lot of people on the sidelines, waiting to go out and borrow money. Rates get cheaper, borrowing capacity goes up. Generally, good news for good quality growth assets. Of course, not a recommendation to go out and buy property, but I think watch this space. The mortgage brokers, the banks, I think everyone's probably going to get quite busy next year as everyone looks at restructuring their debt.
I did also see recently, while on sort of property stuff, that they're looking at changing the sort of serviceability buffers on lending. So I believe they're pricing in around sort of a 3% buffer. So if the current interest rate on your loan that you're going for is say 6%, they have to price in, interest rates going to like 8 or 9, which obviously would be very crippling for a lot of households in Australia. So if they're looking to review that as well, to sort of tone that down to even to say 1.5%, 2%, whatever that is, I'm sure that will obviously be welcomed as well in regards to the lending arrangements and how much people can borrow.
Most definitely, yeah. And I think it's one of those things that I know frustrates a lot of borrowers. If you go into refinance or you're an expat trying to get a new loan, and the headaches of getting paperwork and your pay slips and your bank statements, or having to go to the Australian High Commission to get something witnessed. But then the serviceability buffer being another great example. But all of these things are what makes the Australian property market such a robust place to invest. And while we don't have the bubbles of the United States, and we are a much more stable economy when we look at our residential and commercial property market, because these buffers are in place, because all of these, so not necessarily roadblocks, but checks and balances to protect investors, homeowners, to hopefully avoid some of these bubbles. But I guess, on the note of rates, and it's all eyes on the Federal Reserve, the Australian dollar, what does the RBA do next? Naturally, the recent election in the US, I think it would be probably remiss of us not to at least, I guess, explore, what's transpired since Trump's victory in the US election. Generally speaking, US election outcomes don't have a drastic or sustained impact on capital markets, so equities, bonds. But naturally, this outcome, is going to be quite inflationary. We've had the US dollar strengthening, which came as little to no surprise. I saw this morning some headlines, or over the weekend rather, around Trump basically stipulating to various countries that if they did try to replace the US dollar as a trading currency, that they would basically be punished with quite severe tariffs. Now, naturally, that's meant a couple of things: A, strength in the US dollar, but B, also a bit of strength in Bitcoin. What are you seeing, I guess, Joel, conversations with clients around crypto? And I know it's not an area we like to dive too far into on this podcast and generally, but are you finding more people are talking about Bitcoin now, less, about the same? What are you finding?
There's obviously always a bit of a hype, right? And for the first time, it's been a volatile ride, particularly for Bitcoin post sort of COVID. And recently it's sort of hit again another high milestone. So people are starting to really question again: is this something that is worthwhile for long term? Now, I suppose time will tell, right? And what role cryptocurrencies just generally have, or what role they play in our sort of financial system in 1, 5, 10 years. So I suppose it's always going to be an interest point. I think it's really important to note that a lot of people get held up on the idea that cryptocurrency is an investment vehicle and should replace a lot of other investments, which I think is a very risky sort of strategy. And obviously not one that I would advocate for or advise to do in any sense. But there's particularly around the US as well, a lot of Trump's policies. He's been obviously very vocal around his policy measures, particularly in tariffs and being very America first focused. So, to an extent, that's going to play some role in the success of both the US dollar and alternative currencies, just by I suppose domino design, right?
Absolutely. And naturally that will have an impact on the Australian dollar. It doesn't mean that the Aussie dollar trends much below 65 cents. I'm not so sure. Naturally, the tariffs on China are likely to get a bit worse under Trump. So, we're probably not going to see huge economic growth figures out of China over the next 12 to 18 months. Now, that's obviously going to place some pressure on Australia going forward, which naturally places a bit of pressure on the Aussie dollar, which, for me, as I sit here in Singapore and I look at our clients around the world, whether they're, in the US or Hong Kong or Singapore, earning currencies that are effectively tied to, or at least very closely linked to the US dollar, naturally, that's probably going to be a pretty good time. Whether you're rolling money into super or you're paying down debt in Australia or just sending money back home.
Yeah.
That weakness in the Aussie dollar, I think, is an opportunity to be taken advantage of. Not necessarily something that we are going to be in a position to do forevermore. And yes, the Aussie dollar might get weaker. If it does, we'll be doing more. We're not terribly concerned about trying to pick the precise top or the precise bottom, as it were, but just simply take advantage of where we're at right now.
It's very good that you're sitting in Singapore. It's for, us Aussies here, wanting to go on our holidays. We would like the Aussie dollar just to be a little bit stronger.
Well, as they say, you can't have it all. You've got some nice weather most of the time down there.
Yeah. I think as well, whilst we were just obviously previously on Trump, one of his policies that has not sort of grabbed a lot of attention, particularly in the sort of expat space. And if you're an American citizen, it's one of the downsides is that basically you're taxed on your worldwide income, and you're paying that to the IRS as well. One of his big policies for his election campaign was to end double taxation, or the American, like that sort of non-residency based taxation. So yeah, I suppose it'd be really interested to see how that sort of pans out, because there's so many, I suppose, regulations that go hand in hand with that sort of that taxation treatment, like FATCA, and yeah. Have you had much or any American that you've been speaking to in Singapore that are obviously open to that, or what's the vibe there?
Yeah, look, definitely all eyes on it. I think everyone's taking it with a bit of a pinch of salt at the moment as to, what may play out, if anything, whether it's, that sort of change to that worldwide, taxation on worldwide income, or it's corporate tax reform. No doubt there will be changes. I, for one, would love to see some changes on that front, not just on the worldwide tax side, but even just corporate tax. Place more pressure on Australia to actually reform our corporate tax framework. I would love to see Australia get a lot more competitive at a global level. And not everyone agrees with that opinion. That's absolutely fine. Thankfully, this is a podcast, not an interview, so my opinion is the one that will get heard. But say that, very jokingly, of course. But at the end of the day, I think Australia, needs to look abroad and look at what other countries are doing when it comes to our corporate and individual tax. And if Trump does place more downward pressure on both or just corporate tax, then hopefully we see some more positive steps in Australia as a result of that. Well, look, we might dive into our interview today. We've one of the other big events of the recent history has been the UK budget. Now, we have a lot of Australian expat clients who either live in the UK, spend a bit of time working in the UK, thinking about moving to the UK, or may just have a UK partner. So there is plenty to think about. And of course, this budget has been quite a big one. It's been in the headlines. So we've got the head of ultra high net worth technical services, Brendan Harper, joining us. We're going to unpack the budget. We're going to dive into what it means for Australian expats. So without further ado, we might dive straight in. All right. Well, look, welcome. Thank you, everyone who is tuning into our podcast today. We're absolutely delighted to have an absolute gun in this space, Brendan Harper. Brendan, currently in the UK, is the head of technical services and high net worth services, tax, strategy, structuring with the Utmost Group, looking after UK, Middle East, Europe, and looking after basically global expats right across the world. So we're absolutely thrilled to have him with us. We've just had the UK budget not too long ago, which naturally has plenty to unpack, very relevant to our Australian expat audience. Whether you have assets in the UK, you might have been thinking of moving to the UK, marrying someone from the UK, or even exiting the UK. And maybe those plans have changed as a result of the budget, or maybe you want to know if they should change as a result of the budget. So we've got plenty to unpack. But Brendan, first and foremost, a huge thank you for joining us today.
No problem. It's a pleasure.
Well, look, we'll dive straight in. Maybe as a starting point, I guess, could you give us, in as many words as you would like, a bit of a brief overview, I guess, of some of the key measures that were announced in the budget and maybe how they align to what was perhaps expected?
Yeah. Okay. Well, actually, on that first point, Jarrad, I think a lot of what's been announced has been expected for what seems like a lifetime. Actually, the announcements and what the Labour Party have said for many years in opposition, when they were in opposition, and so a lot of what's happened wasn't unexpected, actually. And just to give you kind of a high level overview, this probably is one of the most important budgets that we've had in the UK for decades. Some of the changes in here will actually, result in different behaviours from certain sections of certain taxpayers, and will really focus people's minds on what they do for future financial planning strategy. And the main headline is the complete overhaul of the special tax regime that applies to people who are considered what we call non-UK domiciled, who live in the UK. They currently benefit from a very good tax efficient regime in the UK. That's all going to be overhauled, and there no longer will be that connection between domicile and tax. for anyone who has a connection to the UK, be they a traditional non-dom living in the UK or considering to come to the UK, or someone who's always been UK domiciled. The rules will apply equally to both people. There were other changes as well that weren't unexpected. So there's been talk of an increase in capital gains tax, for example, for a long time. That's happened. It hasn't been as bad as what some people were predicting. The headline rates will go from 10% and 20% to 18% and 24%. So not as bad as we expected, but it is a rise in the tax rate nevertheless. Some things that actually are not as popular and weren't entirely expected is a restriction on what we in the UK call agricultural property relief and business property relief, which allows you to hand down farms and private family businesses to the next generation. Currently, you can do that with no inheritance tax. That exemption will go and will be replaced instead with a £1 million lifetime exemption with a special rate of 50% of the headline rate, which overall is a 20% rate of IHT. But that nevertheless is proving to be very unpopular and actually the subject of some protests in London already from the farming community. And then another one that was where we were expecting some changes to pensions, but what we got probably a little bit more than what we expected is an announcement that pension funds, so equivalent to a superannuation fund for anyone who's familiar with the Aussie regime, those funds in the future, that is expected that they will be subject to inheritance tax if you leave pension funds behind to your heirs. So there's a lot in there. The non-dom regime is going to be replaced by a new tax regime, which will give some very good tax breaks for people who have been not resident in the UK for a long time and then become resident, but equally not as generous as the rules that we currently have in place.
No, that's fantastic. Look, a lot to unpack there, and hopefully we'll be able to dive into a fair bit of that today.
Yeah.
I guess probably two parts to this next question. For some of our audience, this whole domicile, non-domicile, dom, non-dom terminology may be quite new to them. So maybe, could you just sort of break down what that means in simple terms? And then B, you mentioned some changes to the non-dom tax regime. So maybe you could step us through, exactly what that actually looks like.
Yeah, of course. So the first point, wow, you could do a whole 1-day session on the rules of domicile, which actually, there are similar rules in Australia. So people might be aware of the term, but generally, your domicile from an Australian perspective generally means where you're resident for tax purposes, and trying to break your connections from a residency perspective from Australia. In fact, they have a domicile test for one of the tests for Australian tax purposes on that point, and it all comes from the same root, which is in the English common law, and the concept of domicile is more of a connecting factor than where you're physically present. It's where you consider your permanent home to be. It's all based on your intentions and your actions that you carry out to prove that during your lifetime. And everyone is born with a domicile. And your domicile at first step is that you look to your father's domicile. If your parents were married or in a partnership at the time that you were born, then you would take what we call a domicile of origin that's based on your father, which is actually quite an important point for Australians who are living in the UK, because at first glance, they may consider themselves to be non-domiciled, but actually if they're only a first generation Australian with a British passport and they were born of a father who had recently emigrated to Australia and had no firm intention to remain there, then they could actually have a domicile of origin in the UK. So you need to look pretty closely at Aussies actually to make sure that they don't have that connecting factor. And that's the kind of the difficulty with domicile, is that you could actually be domiciled in a jurisdiction that you have never set foot in. And likewise, you could live for a very long time in a jurisdiction and not have a domicile. So a lot of it is subjective, and it's never been written down in law. It's all based on old case law, some of it going back to the 1800s. And it's very difficult for people to navigate. However, if you are confident that you're non-domiciled and you live in the UK, then you do have the ability then to benefit from this special regime that lasts for the first 15 years of your residence in the UK, whereby you can keep your income and your capital gains overseas. So hold assets that are not UK assets, and any income or capital gains that's generated on those will only be taxable if it's brought into the UK. We call that the remittance basis of tax. It's quite complex actually to administer, and can cost money, especially if you've been in the UK for more than 7 years. You've got to pay a special tax charge every year of 30,000 sterling just for the pleasure of using that regime. And then after 12 years of residence, you've got to pay 60,000 sterling every year to use the regime. And you've got to keep your income and your gains separate in separate accounts so that you don't inadvertently remit money that will be taxable. But then and then also for inheritance tax purposes, non-UK assets are outside of your estate for inheritance tax, and those that are not familiar with it, inheritance tax is quite vicious in the UK. There's a general exclusion of the first 325,000 sterling, which is your tax-free amount, and then over 325,000 sterling, it's a flat rate of 40%, so it hits quite harshly. Non-DOMs can actually escape inheritance tax by keeping assets overseas, and that's what we call excluded property, and they aren't part of their estate as long as they're non-DOM for the first 15 years of residence in the UK. Once they sort of come to hit that 15-year period, there's another planning technique that non-DOMs can use is they can put their overseas assets into a trust. And that trust is what we call an excluded property trust, which means that the assets will never form part of their estate for IHT, even if they become UK domiciled after that 15-year point. And also for income and capital gains tax purposes, it's known as a protected settlement, which means that all of the income and the gains continue to roll up in the trust with no tax taken unless you bring money into the UK. So it's a sort of a permanent tax shelter that is available for people who intend to stay for the long term in the UK. That regime is now going, and in its place, they're bringing in what we call we're now calling FIG, so a new bit of jargon to get used to, which means foreign income and gains. And that's a special regime that will be available to anybody, regardless of their domicile. So domicile will still exist as a legal concept, but it will no longer be relevant for your tax liabilities if you live in the UK, or if you've lived in the UK and you leave the UK. Instead, if you've been living abroad for more than 10 consecutive years, if you come to the UK, you will be able to benefit from FIG regime for the first 4 years of residence. And what that means is that your foreign income and gains, so it's still an incentive to keep money overseas, and those income and gains that are generated on those investments will be completely free of UK tax, regardless of whether you bring them in or not. And you don't have to pay a special rate of tax for it. And there's no other qualifying criteria other than that you had to be resident outside the UK for more than 10 consecutive years. So it's actually quite a generous regime, but it's short-lived. It's only available for the first 4 years of residence. And then after that, then your worldwide income and gains will be subject to tax in the UK in the normal way. I have a sneaking suspicion that they've maybe looked at the Australian temporary residence rules for tax purposes when they've come up with this, because it looks extremely familiar for anyone that is involved in planning for people who go to live in Australia, where you have a very similar tax break for people who are first-time residents of Australia. So it will work in a very much in the same way. Then for inheritance tax, it's slightly more generous in that if you have been resident abroad for more than 10 consecutive years, when you come to live in the UK, your overseas assets will not be subject to UK inheritance tax for the first 10 years of residence. After 10 years, then your worldwide estate will fall into the inheritance tax net. So very much winners and losers there. There are people who are coming to the UK for the first time, or even people who are from the UK who are coming back to live there. Then they will be able to benefit from these special tax regime as well. Potential losers are people who have been living in the UK for more than 4 years, but not more than 15 years, who were expecting to have that non-dom special regime applied to them until they're finished their 15-year period. They will fall into the new regime after April 6th, 2025. And then people who leave the UK, if you've been in the UK for more than 10 years, then your inheritance tax is levied potentially on your worldwide estate. If you leave, then there is a tax tail that will follow you that will mean that your worldwide estate will be subject to inheritance tax for a number of years after you have left the UK. Starting with if you've been in the UK for more than 10 years, but less than between 10 years and 13 years, you will need to wait 3 years before your worldwide estate is free of inheritance tax. And for every other year you live in the UK, you add another year to your tax tail up to a maximum of 10 years. So someone who's been in the UK for 20 years will have to wait 10 years before their worldwide estate is free of UK inheritance tax going forward. Simple, eh?
Do you think, Brendan, is it making it more attractive or less attractive to have a sort of an expat move to the UK?
It's hard to tell at the moment because there's still a lot of noise around the fact that, like every day in the paper and on the various social media sites, there's talk about, all of these wealthy foreign domiciles are going to leave the UK. They're going to go somewhere else to live. It's a disaster, etc. How that pans out long term, we still don't know. There is evidence that some people are actually already considering leaving the UK. the UK. I think the thing that will push people away more than anything, I think, is the inheritance tax. The income tax rates, once you become, you have income above 100, just over 125,000 sterling, you have an income tax rate of 45%, which is again very similar to what you have in the Australian system. I think a lot of people can plan around that. They can put their investments into accumulation vehicles and use whatever tax reliefs are available to them to mitigate the impact of that top rate on their investments as they accrue. And so people don't really get put off by that type of tax rate. But the thought of once you go above 325,000 sterling, that you're going to have a 40% hit on your estate, that maybe you have built up your wealth with no connection to the UK at all. I think that might actually be the biggest disincentive for people to stay long term in the UK. For people who are coming in for the first time, who knows? I mean, there could actually be a new type of foreign individual who comes to the UK, someone who needs to unwind investments, and they live in a high tax country. Ironically, they could now come to the UK and live for 4 years and use the UK as a bit of a tax haven to unwind positions free of tax and then leave again. So maybe more short-term thinking for people who come into the UK. But at
Yeah,
this stage,
sure.
too early to tell.
Yeah. Inheritance tax just seems like it's like, Australia is officially one of these countries that doesn't have inheritance tax officially. So, it just seems to an external perspective, if you're taxed to accrue wealth, obviously through income generation, and then obviously if you were to pass away, you're then taxed on on that estate again. Just I would like to, just for I suppose our listeners here, could you just share a little bit more about the sort of inheritance tax in the UK and sort of any of the changes that have been made in the most recent budget? I know I've seen in the news like people like Jeremy Clarkson, for example, lining up in front of 10 Downing Street with his tractor. So it's obviously
Yeah.
caused quite a stir.
Yeah, it has actually. I mean, it's look, it's a really unpopular tax. Yeah, people's attitudes are that you pay a lot of tax during your lifetime when you're accruing your wealth. Why then pay more just because you've been successful? So it is a very, very unpopular an unpopular tax. I don't see it being abolished in the UK. Certainly not in this Parliament anyway. It works at its basic level, it's a very simple structure. Currently, it's based on your domicile. So if you've got a UK domicile, or you're deemed domiciled because you've been in the UK for more than 15 years, if you were non-domiciled previously, then it impacts on your worldwide estate. So all of your global assets are totted up on death, and the first 325,000 is available to you as an allowance that's free of tax, and then after that it's a straightforward 40% hit. Now that, for people who leave the UK, that's actually a tale that can last their whole life, because if they don't change their domicile, and to be able to change your domicile, you've got to show that you're going to settle permanently in another jurisdiction and have evidence to back that up. By putting down real roots and connections and economic connections to the country, and giving up important social, economic connections with the UK to show that you've left permanently. So it's quite a subjective process that people go through. So they always have this kind of looking over their shoulder element that, have I really done enough to change my domicile to escape IHT? For people who come to the UK, so Australian expatriates, then again, at the moment, all they need to do is show that they have no firm intention to remain in the UK, and their domicile stays with them, their domicile of origin, and all they need to do is hold their money overseas. But after the 15-year point, then they need to do some other planning, and it's relatively simple to do that planning. Inside of that regime, then there are certain reliefs that you can claim. So the stuff that you've seen in the press and the headlines are that currently, I think there are three main exemptions in the UK that apply to people's wealth. One is business property relief, where you have a family business that you pass to the next generation. You can claim 100% relief on that, so there's no inheritance tax. Likewise, with agricultural property, there's 100% relief on agricultural property. Now, there's some rules around showing that it's really a farm and it's really a business, and there's a qualifying period that you have to be doing it for. But generally, it means that generation after generation, you can pass these assets down free of inheritance tax. And then the other one is that if you build money up inside a pension, so a superannuation fund, then that is not subject to inheritance tax. So if you leave money behind in that fund for your nominated beneficiaries, they can draw down on that pot of money free of inheritance tax. They're the three areas that are proving to be the most unpopular from what the government has announced. The first two will bite next year, which is why they're the subject of protests from the farmers. You've seen Jeremy Clarkson on telly, etc. The one on pensions is not due to bite until 2027. So we will now enter into a period of consultation, which maybe fingers crossed will, you know, reduce the impact of that tax. But if it goes ahead in the way that it's been announced, then it really will change behaviors, I think, because at the moment, when you do financial planning for people with UK connections, you generally tell them in retirement to draw down on assets and investments that are outside of their superannuation fund first. So if they have insurance policies or investment funds that they hold, then use them to fund their retirement in the early years and try and park out the taking of your pension for as long as you can, because it sort of acts like a family trust that can be passed on free of tax. And that's been the case since 2015. If it goes ahead, then I think we'll go back to what we used to tell people before 2015, which is to run down your pension fund first and keep your other assets structured in a way that maybe you can keep them out of your estate for inheritance tax. And there are techniques to do that with certain assets, but run down your pension first, because you can't transfer it, you can't do any planning with it. You either take an income or you leave it in the pot and don't take an income. So take the income to run down the value of it to escape the impact of inheritance tax.
Brilliant. So a lot to think about there. I guess you've touched on a few reliefs, dates these things come in. I guess at a high level, are there other things that Australian expats, again, given our audience who may be residing in the UK, may have been there for a while, should be thinking about to sort of mitigate, reduce, escape these inheritance tax changes in the UK?
Yeah, I mean, and that probably goes further than just inheritance tax as well. But I suppose, when I come across Australians in the expat markets, unlike other global expat populations, they do tend to intend to go back to Australia at some point. A lot of other expatriate. So if I talk to expatriate Brits, for example, I mean, this might change now because of the 10-year inheritance tax-free period when they come back. But there are many more people in the British expatriate community overseas who don't intend to come back to the UK because they get used to good weather and good lifestyle, etc., and they just don't want to come back to cold, dark winters yet. Whereas I think the Aussies tend to, when you speak to them, it might not be for some time until way in the future, but there always seems to be that connecting factor back to Australia, and then eventually that's where they intend to go. So I would say that any planning that they're doing with an eye on going back to Australia is still as valid now as it was before the budget. So one common technique is to use an insurance policy to save up a retirement fund in, and you can put money into that every year within certain limits. And once it's been enforced for 10 years, even if you're still outside Australia at that point, when you go back, then you can draw down on the accrued investment free of tax, because the Australian tax rules give you this generous tax break for insurance, where once it's been held for 10 years, there's no tax on the benefits. You can structure insurance so that it works well for them when they're living in the UK. So it can roll up, and that accumulating factor that they get when they're in Australia works equally well for them when they're residing in the UK. So they can kind of ignore all of the noise at the moment around the non-dom rules changing, particularly if they are out of the 4-year period where they can't use the benefit, the ability to have foreign income and gains tax free. Then accumulating in a vehicle like insurance makes a lot of sense, because it means that they can just accumulate up the investment and not pay tax unless they take money from it. They can draw down on it when they're in the UK if they need the money, and there are ways to do that without paying tax or mitigating their tax exposure. And then when they go back to Australia, they have this large pot that's available to them when they go back that can supplement their other retirement income. So I would say that those people, there's no change to any of this. They can continue to have that strategy and it works perfectly well for them. For those who maybe in the UK, more high net worth Australian expatriates, if they have planned around the remittance basis until now, then they need to seek advice because that's going. And that may mean that they need to do something different with the structures that they've put in place. And also, actually, which we haven't touched on, is that if they have used a remittance basis in the past and they have income and gains that they have stored up overseas, which would get taxed if they bring them into the UK, so they're very careful not to bring them in. They do have the ability after April 2025 for a 3-year period to use what we call the temporary repatriation facility, which will allow them to bring in income and gains from overseas and pay a special rate of tax of 12% for the first 2 years of that regime, or 15% in the 3 years. And that's a use it or lose it opportunity. Once the 3-year period goes, then they won't be able to do that. So a lot of people at the moment, and high net worth Australians are in this as well, and they've got to be in this thought pattern at the moment is, will I ever need this money in the UK? If so, then is it better if I take it in and pay 12% tax, which is a very generous rate of tax compared to 45% potentially higher additional rate tax, so that I can just clean it all out and then I can use it in the UK? Or others will be saying, well, I will never need this money when I will never need this money in the UK. So therefore, I don't need to pay the 12%, but I will keep that money overseas. So yeah, if your clients or if anyone's listening hasn't taken advice on that, then they really need to. And then the inheritance tax side, anyone who was clever enough to set up a excluded property trust before the 30th of October can continue. There wasn't an element, a limited bit of grandfathering of those trusts, whereby you can continue to be a beneficiary of the trust and it won't form part of your estate if you then subsequently pass away, and therefore it acts as a sort of a permanent inheritance tax shelter from that 40% rate of tax. However, once they have been in the UK for more than 10 years, then at the next 10th anniversary of the trust, there is what we call a relevant property regime that applies to trusts, which would charge what we call a periodic charge. I'll get a bit technical here, but the maximum rate of tax on that periodic charge every 10th anniversary is 6% of the trust fund value. So a lot of people will be thinking now, do I keep the trust because it got a very generous treatment for me as a beneficiary of that trust in that it avoids 40%, but the price I will pay for that is that if I'm still in the UK after 10 years, that there will be a maximum 6% charge. So people will be saying, is it worth paying 6% every 10 years to avoid the 40%? And for those who didn't do an excluded property trust before the 30th of October, then they need to think about new ways of planning. And there are trusts that you can do that have been used habitually by people who are what I call traditionally UK domiciled, don't benefit from special tax regime. There are techniques that they can use to mitigate the impact of inheritance tax as well. And if people are living long term in the UK, they maybe have to consider some of those techniques going forward, or leave the UK before you hit the 10-year residence point, to make sure that IHT tail doesn't follow you when you leave the UK.
Wow, plenty there. Gosh, I guess
Yes.
changing tact a little bit, but I guess still all under the same umbrella of private wealth. What about UK property? physical, either property that you're living in or property to invest in, whether I'm thinking about buying one, I already own one. Are there now different things I need to be thinking about, planning for? Should I be selling? Is it more attractive now? What changes do I need to be aware of?
Yeah. Well, I mean, obviously, if it's the family home, then tax is probably not the biggest driver for whether you decide to keep the property or not. But certainly, UK residential property as an asset class over the last decade, from a tax perspective, has become a lot less attractive. It used to be that, particularly for people who are what I would call traditionally non-dom or foreign investors, they could at one point buy a UK residential property through an offshore company, a non-resident company, and then they could pass the shares in the non-resident company through their estate, and that would turn UK property into non-UK property, and thus would wipe out the inheritance tax exposure just purely by using that planning technique. That's gone. In fact, it's more punitive now to hold residential property through a foreign company. And there's a complete look through for inheritance tax. So any overseas company that derives any of its benefit or value from UK residential property, then the transfer of the shares themselves is a transfer of value for inheritance tax. So there's no real escape from that. And I would look out for wacky schemes that purport to tell you that you can avoid it by doing something, because there are targeted anti-avoidance provisions that are pretty aggressive and will attack those structures. Really, the only way to plan for inheritance tax now for residential property is either sell it so that you don't have the exposure to it, or use protection to cover the liability. So a pure life insurance policy written into trust for your beneficiaries that will actually pay the inheritance tax once there's been a transfer of value. So really, that's the position for inheritance tax. The only other real change to look out for people in our markets is that stamp duty, land tax is still a big revenue raiser, and governments keep putting it up. And that was the case in the budget as well. So we have rates in the UK that start currently. The first 250,000 sterling purchase price is zero rated for stamp duty land tax, and then it sort of goes up in stages after that, up to a maximum of 12% on anything over 1.5 million sterling. That threshold is dropping in April, so to 125,000. So more properties at the lower end of the chain will come in, and that first rate is 2%. Okay, so not too bad. However, if it's not your first property, so if you already have another property, then you got to add 3% to the standard rate of SDLT at the moment. That's going to 5%. Okay, so that's been increased by 2%. And then if you're non-resident, so if you're a foreign resident investor into UK residential property, you got to add another 2% on top of that. So a very typical expat case would be someone who lives abroad. They already own a property in the country where they're living. They want to buy a residential property in the UK, maybe either for a buy-to-let or somewhere that they want to go to live in eventually. Then they're starting already with an extra 7% stamp duty land tax even before they apply the standard rates to that. So someone who buys a property at over the maximum threshold, 1.5 million, which is not a lot if you're buying a London property, then your stamp duty land tax for a non-resident with already owning a property is 19% of the purchase price. So people at the lower ends, even, so like a 500,000 sterling property in the UK. If you're a non-resident with already owning a property, then you've got to think that you've got to put 25,000 sterling onto your purchase price. That's how much it'll cost you in stamp duty, land tax. So yeah. I think that it may cause people, to rethink whether it's worth investing into UK property when they got that kind of outlay. Yeah. And then obviously there's capital gains tax as well, which if you sell the property, even if you're non-resident, you used to be able to sell that with no capital gains tax. That's gone since 2015. So every which way you turn now, you're pretty much getting taxed on the way in when you sell it, your rental income, and when you leave it, when you die. UK residential property is on the hook for tax at every stage.
It's definitely something to consider. Like, it sounds big when you speak of it like that,
Yeah.
Brendan. Particularly, I know that earlier you were talking about obviously inheritance tax and selling assets or even restructuring those assets. It would be good, obviously, if you could just give us a bit of a run through about sort of this new capital gains tax regimes. Like, what does that mean if you have to sell assets or in the UK now?
Yeah, well, the first thing you got to look at is the asset, the type of asset that is subject to capital gains tax in the first place. So, and for people who have lived abroad, or they're in the global expat space, they may have collected assets, and especially really in terms of their investment portfolio. They may be in funds, for example, where they think, if I sell this, I'll get capital gains tax treatment on this, which is a much more generous rate, even at the 24% higher rate. It's a lot more generous than the income tax additional rate of tax, which is 45%. But you got to be in the right type of fund. So if you own an investment fund that you purchased abroad, which doesn't distribute the income, it accumulates it up in the bid price of the fund. It doesn't produce reports and accounts that are structured in a way for UK tax compliance, and it's not registered with HMRC as a what we call a reporting offshore fund, then it doesn't get capital gains tax treatment. What it gets is income tax treatment on the profit when you sell it. So you've got to really have a good advisor who can navigate both the overseas element and the UK element, and advise you on how the two work together. If you've got the right type of fund, then your return isn't all going to come from capital gain. Some of your returns every year will come from income. There will be a dividend that will be distributed in that fund. Even if you're in an accumulation unit, you've got to have a voucher that you can declare each year on your tax return, and then you pay income tax rates on those dividends. So your return is not really always going to be capital gain. So they're the things you got to think about. But then if you do sell it, then you can book in this more favorable rate. And then when it comes to the calculations, you've got to track. You've got to track all of the income receipts that you've received, because they could actually be booked in as an addition to your base cost. And then you got to track if you're doing, so for example, if your advisor is running your portfolio where they do a rebalancing exercise on a yearly basis, then any of those rebalances will crystallize disposals for capital gains tax. So you've got to be aware of that. And your advisor's got to be aware of that. And the other thing that's happened with CGT over the last couple of years is that there used to be quite a generous exemption that was 12,300. So your first 12,300 of sterling of gain was tax free. So a lot of what I call mass affluent investors with a reasonably decent sized portfolio may be able to rebalance and keep it within the annual exemption so they don't worry about CGT. That's now fallen to 3,000 sterling. So it's more likely that if you have an investment portfolio, that if you do a rebalancing exercise, that you could end up with a capital gains tax charge that will apply. And obviously that will then reduce the return over the long term. You can ignore all of that if you're using accumulation structures. So that technique that I talked about, where an Australian expatriate can build up wealth inside an insurance arrangement with a view to using it when they go back to Australia for retirement, that accumulating factor, all of the income and the gains are all offset against each other inside the box. You got nothing to worry about putting on your tax return. There's no exit charge when you leave the UK. If you want to draw down on it when you're in the UK, then you can use techniques to do so without exposing yourself to tax. So again, that makes more sense for people who are planning with an eye on returning to Australia in the long term.
Yeah, of course. And I suppose while we're on that sort of broader discussion of drawing down on investments, pensions, or our superannuation system here is obviously, would say, one of the key backbones of both of our retirement, systems. What has those sort of pension changes that you'd mentioned earlier as part of the budget? Is there any, I suppose, particular planning strategies that expats should consider in light of changes, particularly for the pension system?
Yeah, I mean, it's uncanny how similar the two systems are, actually.
Mm.
In fact, I think a lot of the current structure in the UK in the private pension space, a lot of it was borrowed from the Aussie superannuation regime anyway, and it seems that every time the UK copies something that is good about the Aussie one, the Aussies then make that good thing restrictive. So for example, at one time there was no limit on how much you could keep in a superannuation in Australia. We had a similar regime in UK, but we had a limit, and then the Aussies then introduced a limit, so we got rid of ours, and then we've got ours back again, and so essentially where we are now with a private pension arrangement, so not a traditional DB scheme where you get a guaranteed income, but a DC scheme where you just build up a pot so that you can take. The two systems are very similar. You get tax relief on your contributions on the way in. We in the UK we have accumulation that rolls up gross, unlike where in Australia where you've got a 15% hit on the accumulation as well. So for an Aussie living abroad, it's more attractive maybe to keep the money outside the superannuation while they're living abroad, because they don't have that exposure to the Australian tax on accumulation. And then when you draw down on the benefits, the Aussie system looks potentially more generous after age 60, because you can get tax-free drawdown, although that's now capped. I think 1.6 million is it in Aussie dollars, that there's a cap on how much you can draw down. In the UK system, because you had gross roll up on the pension, when you take your income, it's taxable in the UK. The first chunk used to be, it was 25% of the value of the pension could be taken as a tax-free lump sum. That's now been capped at just over 268,000 sterling. So anything over that then is treated as taxable income. Now, if someone builds up pension entitlement while they're living in the UK and then they go back to Australia, there are certain little quirks in the way that it works that they need to be aware of. So, for example, if they take their tax-free lump sum from a UK perspective, it's free of tax, but it may not be free of tax from an Australian perspective. It may be seen as foreign pension income. So therefore, does it make sense to take their tax-free lump sum before they go to Australia so that they bring in that capital and then do some planning with that? Then if they draw down an income, then it's taxable source income in the UK, but the double tax treaty between Australia and the UK will mean that they can draw down the income with no UK tax on it, but they'll pay tax in Australia. The one thing now that wasn't there before, but will come in the future, is that fund will be subject to UK inheritance tax. So if the fund is over, imagine if they have nothing else connecting them to the UK, but their pension fund, and it's more than 325,000 in value in sterling terms, then there's a 40% hit on that. So again, there's probably more of an incentive then to think, well, actually, do I take all of this pension as soon as possible to mitigate the impact of that? And then finally, is it worth my while to try and transfer that pension to Australia? There's a lot. It's a lot more difficult to navigate that now, but it's still possible for someone who's over the age of 55 to transfer a UK scheme into a qualifying superannuation plan in Australia. And the advantages that they get from that is that they now have no tail in the UK that can come back to bite them. They only need to worry about the Australian regime. Maybe they can get the attraction is even just from a currency perspective that they now have a pot that's in the Aussie dollars and they can spend it in Aussie dollars. Plus also, if they're within the right limits, then they can also potentially draw down free of tax after age 60 when they retire in Australia. So there's still a lot of, I think, benefits of doing that, but you really do need to get advice from advisors who are familiar with both regimes, so that there's a lot of traps for the unwary in there as well.
For anyone who might have been thinking of moving to the UK, hopefully that hasn't been completely terrifying, and you can really unpack what Brendan's being so kind to share with us today. As I think you've really picked up, whether it's property or it's IHT or it's pensions or it's assets in the two countries, getting proper advice, as Brendan said, from somebody who does understand both is just so critical. When the difference is 0 to 40%, or in some cases even higher, spending a bit of money, spending a bit of time to actually get that proper advice before you make the move, before you make the decision, it's just going to pay for itself many times over. But Brendan, look, on behalf of both Joel and I, and of course our community, huge thank you.
As mentioned there's plenty to discuss around the sort of UK budget and lots that's happening around the world. As we mentioned, we'll be releasing a podcast each month on the last Wednesday of the month. So please subscribe and continue to send through your feedback. We will look to continue interviewing experts each month, ranging on repatriation, moving money abroad, preparing wills overseas. And of course, if there's anything that you'd like to listen or is going to be an interest or a topic area, please just drop us a link or a comment, and we'll be sure to find some more information and put out an episode on that. The podcast is available on all major podcast hosting services, so please find us, subscribe, and check out resources that are available as part of the podcast.
Thanks, Joel. Yes, as mentioned, please do leave us a note with any questions, comments, leave us a review. And if you found value in this content, please do let other people know. However you found out about it, however you found about us, shoot the link across to a friend who it might benefit, either a topic or the show itself. Our sole aim with creating this podcast is to ensure that we're providing value and hopefully unpacking some of those more complex finance topics that impact Aussies all over the world. We are on all the social channels, so do find us. We're at Moneyside Up, Facebook, LinkedIn, Twitter, X, depending on your preference. Next month, we have another great speaker. We'll be heading into 2025, hopefully with a bigger, better, more informative, more engaging, hopefully even maybe more entertaining podcast for the year ahead. But a huge thank you for joining us. If we don't speak to you beforehand, wishing everyone a very Merry Christmas. Stay safe, be merry, enjoy your time with family and friends, and we look forward to connecting with you in the new year.
Thanks for tuning in.